So it was on April 4th, 2020 when Jamie Dimon, the chairman and CEO of JP Morgan Chase and Company, released the annual report. This is his annual letter where he talks about the company, but most importantly, he talks about his outlooks on the economy overall. Jamie Dimon is a behemoth in the markets and so many people respect his opinions. On this video, we are going to go over some of the main things that were said in this annual letter and what they mean for us moving forward. Now, these are opinions, and on this video, I'm going to provide you with my opinion as well. None of this is fact. It's just hypothetical, what we think could happen in the future, what we think is likely to happen in the future. Now, if you're new to this channel, my name is Sean. This is We Are Investing, a channel that's dedicated in investing and personal finance. So if you like that kind of content, then definitely consider hitting that subscribe button, ringing that bell, and smashing that like button to help with the YouTube algorithm, and also so that you are notified when we upload more videos. Now, like I said, in this video, we're going to dive deep into the main things that were provided in this annual letter, and we'll provide more color on them as well. So without further ado, let's get started. Now, one of the things that was hinted at in this annual letter was stagflation and the possibility that we could be heading towards stagflation in America. If you don't know what stagflation is, it's horrible. It's when we continue to see inflation on consumer goods, but wages don't rise with it. Things cost you more, but you're not making more money. And that is horrible for the economy, and that is horrible for the consumer. It's definitely something that we want to avoid at all costs if we can. Now, directly from his annual letter, it states, in today's economy, the consumer is in excellent financial shape on average, with leverage among the lowest on record, excellent mortgage underwriting, even though we had some home price appreciation, plentiful jobs with wage increases, and more than $2 trillion in excess savings, mostly due to government stimulus. Most consumer and companies and states are still flush with the money generated in 2020 and 2021, with consumer spending over the last several months 12% above pre-COVID-19 levels. But we must recognize that the account balances in lower income households, smaller to begin with, are going down faster, and that income for those households is not keeping pace with rising inflation. Main takeaways from this paragraph are that spending is 12% over pre-COVID-19 levels. The cash that consumers and companies and states have right now is mostly because of government stimulus, $2 trillion in government stimulus. And probably most important is that income for those households is not keeping pace with rising inflation. Inflation is outweighing wage growth, and that is a sign of stagflation. And as the consumer starts losing that cash that they got from stimulus because they're spending more than they were before, then they are going to be stuck in a situation where they also will be dealing with stagflation. Inflation is extremely important to get under control. The entire world is dealing with inflation. It's not just here in America, but it's important that we get it under control. If we do not get it under control, then stagflation is a huge risk, and it's something that we need to avoid at all costs. The next thing that was hinted at in this annual letter is the Fed policy moving forward and the likely path that they're going to have to take and the impacts that that can have on the markets. Inflation is key to everything in this annual letter. Even when talking about the war in Ukraine, inflation is part of that because of the rise in costs of commodities and the inflationary pressures that has. But nevertheless, it was stated that persistent inflation will require raising interest rates and a massive but necessary shift from quantitative easing to quantitative tightening. Quantitative easing is the environment that we've had for quite some time. Even leading up to the pandemic, the Federal Reserve was dropping interest rates, but when the pandemic hit, they slashed interest rates. In addition to that, they were also pumping the markets with money. The Federal Reserve was buying treasuries and mortgage-backed securities. This was directly infusing the financial markets with cash, US dollars. That is a quantitative easing policy. On the flip side, quantitative tightening, well, that's the policy and the path we are heading towards. Quantitative tightening is when we start to rise interest rates, which they are started doing, and they are going to start selling bonds and mortgage-backed securities, or at least letting them run off on their balance sheet and not buying more to replace them. This has the opposite impact of quantitative easing. This is going to help take money out of the system, make money harder to get, and it's going to tighten the financial markets. And as stated in this annual letter, the shift from QE, quantitative easing, to quantitative tightening will cause a massive change in the flow of funds in and out of treasury bonds and therefore all securities. This massive change in the flow of funds triggered by Fed tightening is certain to have market and economic effects that will be studied for decades to come. Our bank is prepared for drastically higher rates and more volatile markets. In my opinion, it is certain that the Federal Reserve is going to have to raise rates at a pace that is much higher than expected because inflation is just not getting under control. In addition to that, they are going to have to do additional quantitative tightening to the balance sheet by rolling off a ton of treasuries and maybe even selling some of the treasuries that they have on their balance sheet. This can and will likely have a huge impact on rates, whether it's a 30-year fixed mortgage rate or the rate you get for a 10-year, 20-year, 2-year treasury. It's all going to be impacted by this quantitative tightening policy. And I, for one, see an opportunity here. That is why I am buying leaps in the TBT, which is basically short the 20-year bond and it's long the rate or the yield of the 20-year bond. For more information on that and those kinds of strategies, well, you can follow this channel. You can also join the Discord by joining the Patreon. A link is provided down below, a chat room where you can talk to me and other investors every single day. But nevertheless, you know the saying, don't fight the Fed. Well, during the time where the Fed was pumping money into the markets, it made a ton of sense to be long the markets. Well, now the Fed is doing quantitative tightening, and actually being long the markets is fighting the Fed. Being long yields and rates is not fighting the Fed, and the Fed is your friend in that case and will help you make money. Another big thing that was mentioned in this annual letter is the supply chain and the restructuring of supply chain that we're likely to see in the near-term future. And we're actually starting to see this in some cases today. Directly from the annual letter, it states there is no question that supply chains need to be restructured for 3 different reasons. For any products or materials that are essential for national security, think rare earths, 5G, and semiconductors, the U.S. supply chain must either be domestic or open only to completely friendly allies. We cannot and should not ever be relying on processes that can and will be used against us, especially when we are the most vulnerable. For national security reasons, activities, including investment activities that help create a national security risk, i.e. sharing critical technology with potential adversaries, should be restricted. Companies will diversify their supply chains simply to be more resilient. This restructuring will likely take place over time and does not need to be disruptive. Some of the main beneficiaries will be Brazil, Canada, Mexico, and friendly Southeast Asia nations. This, I think, speaks volumes. There's a lot of opportunity here with this restructuring of the supply chain. Some companies might thrive because of this. The federal government is going to put money to secure the supply chain for national security reasons, as they should, because we can't be relying on another country across the world who might use this against us for national security purposes. So think companies like Intel, which is putting a ton of money into foundries so that we can manufacture chips here on US soil. So shoring up the supply chain is a huge priority, and companies are going to start seeing this. I think a lot of companies are going to start shifting the focus of their supply chain. The prior focus was on profitability and speed. How much can they get out there? The new focus is going to be on reliability and security. The fact of the matter is, during this pandemic, we all realized that a lot of our supply chains were very weak, and it didn't take much to completely crush the system. And I think these companies are starting to realize it's more important to have a reliable supply chain than one that's going to make them a little bit more money. Because what happens is when we have events like this and they can't make any products, well, they actually end up losing more money. So I think the path to that's going to happen in the future, and this is going to take some time, companies are going to focus on securing their supply chain, meaning they're not going to be able to make as much products as quickly as they were before. Also, it's going to cost them a little bit more to do so because of that security. This shift in the supply chain, although it is extremely necessary, could actually end up rising the cost of goods and be inflationary. And that might be one reason why this inflation is going to be very persistent and not transitory. Now, this annual letter was extensive. There was a lot that he talked about, but those are the three main things that I saw in this annual letter. The first is we could be seeing stagflation. The second is that the Federal Reserve is probably going to be more hawkish than people actually realize. And the third main thing is we could see a new global order and a focus on securing up the supply chain within our own country and our friendly allies, which is extremely important but could lead to more inflation in my personal opinion. Now, down below in the video description is a link to the annual letter itself. If you have some time, I definitely would recommend checking it out. But that about wraps it up for this video. If you like this content, then consider hitting that subscribe button, ringing that bell, and smashing that like button. Also, please consider joining the Patreon. A link is provided down below in the video description. Outside of that, I'll catch you all on the next video. It's been real. It's been fun. It's been real fun. This is We Are Investing, and together we are invincible. See ya.